The sound is not a roar, not at first. It is a mechanical, rhythmic chattering, like the mandibles of a billion insects devouring a harvest. Click, clack, whir, click. This is the heartbeat of American capitalism on Tuesday, October 29th, 1929. But today, the heartbeat is arrhythmic. It is seizing. If you were standing on the floor of the New York Stock Exchange at noon, the first thing to assault you would not be the noise but the smell. The ventilation systems of the 1920s are woefully inadequate for a panic of this magnitude. The air is thick, almost gelatinous, composed of stale tobacco smoke, the sharp metallic tang of fear-induced sweat, and the dust kicked up by 3,000 frantic shoes. It is the scent of an animal cornered. In the center of this maelstrom stands a glass-domed machine, no larger than a toaster, the ticker. For 8 years, this device has been the oracle of the new religion. It printed wealth. It turned shoeshine boys into tycoons and schoolteachers into speculators. It was the unerring source of truth. But today, the machine is lying. This is the specific horror of this moment, the detail that history books often gloss over in favor of charts and graphs. The panic of 1929 was not driven solely by falling prices. It was driven by blindness. The volume of selling is so catastrophic, so unprecedented, that the technology cannot keep up. The ticker prints at a maximum speed of 285 characters per minute. It is a marvel of the industrial age, but it is finite. The selling is infinite. By 1 p.m., the ticker is running 60 minutes late. Pause and consider the psychological violence of that lag. Imagine you are a floor trader. You are holding a slip of paper ordering you to sell 5,000 shares of Radio Corporation of America at market. You look up at the board. The tape says RCA is trading at $40. But that price is from an hour ago. That price is a ghost. In the real time of the trading pit, RCA might be at $35. It might be at $20. It might be zero. You do not know. No one knows. This is the death of information. In financial markets, price is the signal that coordinates human action. When the signal is severed, the market ceases to function as a mechanism for price discovery and becomes a mechanism for pure hysteria. This is the fog of war descending upon Wall Street. Men are screaming. Not the boisterous shouting of a bull market, but the high-pitched, jagged screaming of men watching their entire existence evaporate. They are waving sell orders in the air, their knuckles white, their faces drained of blood. They look less like financiers and more like the damned in a medieval painting. They are begging anyone at all, to take the paper from their hands. But there are no buyers. The bids have simply vanished. It is an air pocket. The floor drops out and the stomach lurches. A clerk, his collar unbuttoned, runs past a post where U.S. steel is traded. He sees a specialist, the man responsible for maintaining an orderly market in that stock, simply standing there, arms at his sides, staring into the middle distance. The specialist has stopped shouting. He has stopped writing. He is witnessing a mathematical impossibility. The bluest of the blue chips, the steel that built the skyscrapers of Manhattan, is finding no bottom. Outside on Wall Street, a crowd is gathering. Rumors are moving faster than the ticker. They say the exchange has closed. They say the banks are insolvent. They say 11 speculators have already jumped from high windows. The suicide rumors are mostly exaggerated, a grim folklore being written in real time. But the crowd believes them because, in this atmosphere, the horrific feels more plausible than the rational. The police arrive, mounted on horses, struggling to hold back a throng of 20,000 people who just want to know if they are still solvent. They press their faces against the stone facade of the building as if trying to hear the verdict through the walls. Back inside, the clock ticks toward 3 p.m., the closing bell. Usually this sound brings relief. Today it brings a strange, suspended animation. The trading stops, but the noise does not. The ticker is still running. This is the final, cruel irony of Black Tuesday. The market has technically closed. The shouting on the floor dies down into a low, stunned weeping, and the shuffling of paper debris that is ankle-deep, looking like gray snow. But the machine in the corner is still chattering. Click, clack, whir. It is printing trades that happened hours ago. Traders do not leave. They cannot leave. They stand in the debris, paralyzed, watching the tape. They are watching a replay of their own execution. The tape will not stop printing until 7:45 p.m. that evening. For 4 hours after the market closes, the machine continues to vomit out the record of the day's destruction. Men stand and watch their net worth disappear retroactively. They realize that when they thought they were worth $1 million at 2 p.m., they were actually already bankrupt. In the offices of the brokerage houses, the telegraph machines act as the Grim Reaper's messengers. They clatter out margin calls to every corner of America. To the dentist in Des Moines, the grocer in Brooklyn, the widow in Chicago. The message is the same: send cash immediately or we sell. But they can't send cash. The cash is in the stocks, and the stocks are gone. As the sun sets over lower Manhattan, casting long melancholic shadows through the canyons of steel and stone, the lights in the skyscrapers remain on. It is a city of insomniacs. The smart money, the Rockefellers, the Morgans, the Livermores. They are in their boardrooms, surrounded by cigar smoke, trying to calculate the damage. They are doing the math of survival. But for the common man, for the dreamer who believed the narrative of the Roaring Twenties, the math is simple and brutal. The illusion of permanent prosperity, carefully constructed by cheap credit and exuberant marketing, has been shattered by the reality of the ledger. The silence that follows the stopping of the ticker at 7:45 p.m. is heavy. It is the silence of a vacuum. The roaring engine of the American dream has not just stalled, it has exploded. And as the exhausted clerks sweep the floor, pushing mounds of ticker tape into trash bins, they are not just sweeping away paper. They are sweeping away the optimism of a generation. The 1920s died in that room, strangled by the very machine that was supposed to measure its pulse. The Great Depression has not officially begun, but the psychological immune system of the nation has been compromised. The fever has broken, only to be replaced by a chill that will last for a decade. To understand the violence of the crash, one must first understand the seduction of the boom. The catastrophe of 1929 did not begin with a sudden loss of confidence. It began with an excess of it. It began with a cultural and psychological mutation that fundamentally altered the American character. Before the 1920s, the American financial ethos was carved from the granite of Puritanism. It was Benjamin Franklin's America. A penny saved is a penny earned. Debt was a sin. Speculation was a vice akin to gambling or drinking. The stock market was a closed club for the robber barons, the Morgans, the Carnegies, the Rockefellers. It was a place where wolves ate wolves, and the sheep, the common public, stayed in the pasture of savings accounts and government bonds. But as the dust settled on the First World War, something fractured in the collective psyche. The horrors of the trenches had loosened the grip of old morality. If life could be extinguished so cheaply in the mud of France, why hoard pennies for a future that might never come? The ethos of save was replaced by the imperative to live. And to live in the 1920s required money, vast, impossible amounts of it. This was the birth of the new era. It was not merely an economic boom, it was a mass hallucination fueled by the most dangerous phrase in finance: this time is different. The engine of this delusion was technology. We often look back at the 1920s in sepia tones, imagining it as ancient history. Yet the psychological landscape is terrifyingly modern. They were living through a technological disruption that rivals the internet or artificial intelligence today. In the span of a single decade, the horse was replaced by the Ford Model T. The silence of the evening was filled by the radio. The darkness was banished by electrification. Consider the Radio Corporation of America, RCA. To the investor of 1928, RCA was not just a company, it was a miracle. It was the Google, the Amazon, and the Nvidia of its day wrapped into one. In 1920, the idea of a box that could pull voices from the ether was witchcraft. By 1929, it was in every living room. Here we encounter the first major psychological trap: the halo effect. The human mind struggles to separate the brilliance of a product from the value of a stock. Because the radio was a revolutionary, world-changing invention, Investors assumed the stock price of RCA must offer revolutionary, world-changing returns forever. They conflated utility with valuation. In 1924, RCA shares traded at roughly $11. By 1928, they had surged to over $400 before splitting. It was a stock that did not pay a dividend. It was a pure speculation on the future, and yet the public bought it with a religious fervor. They weren't buying a share of a corporation. They were buying a ticket to a utopia where labor was obsolete and wealth was automatic. This belief was not accidental. It was manufactured. The architectural design of this excess came from the very top. Andrew Mellon, the Secretary of the Treasury, a man carved from cold marble, slashed income taxes for the wealthy, flooding the system with capital. The Federal Reserve, in a fateful attempt to help Britain return to the gold standard, kept interest rates artificially low in 1927. They pumped cheap credit, the oxygen of a bubble, into the room. But the most critical shift was the democratization of greed. Prior to this decade, the average American had never seen a ticker tape. But the Liberty Bond drives of World War I had taught the public how to invest in securities. Once the war ended, the bankers needed a new product to sell to this awakened mass of capital. They built brokerage parlors on main streets across America. These were not the stuffy, oak-paneled rooms of lower Manhattan. These were designed to be seductive. They opened branches in uptown New York specifically for women, a demographic previously ignored by Wall Street, fitting them with plush armchairs and tea service. They made the stock market fashionable. It became the primary topic of conversation at dinner parties, barber shops, and speakeasies. The narrative was intoxicating. John J. Raskob, a senior executive at General Motors, published an article in the Ladies' Home Journal titled, "Everybody Ought to Be Rich." His thesis was simple. If you saved just $15 a month and invested it in common stocks, with dividends reinvested, you would have $80,000 within 20 years. In an era where the average annual income was $1,500, Raskob was promising a fortune. He was telling the plumber and the nurse that they were not workers. They were capitalists in waiting. This leads us to the most potent psychological force of the era, recency bias. By 1928, the market had been rising for nearly 7 years. A generation of investors had entered the market, knowing nothing but an upward trajectory. The human brain is a pattern recognition machine. When a pattern repeats often enough, up, 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 the brain hardwires it as a law of nature. The possibility of a crash was not just ignored, it was neurologically deleted. The bear market was considered an extinct species, something that happened to their fathers, not to them. The skepticism of the old guard was washed away by the profits of the new. If you were a prudent investor who looked at P/E ratios and dividends, you were losing money. If you were a reckless gambler throwing darts at the board, you were getting rich. The market was actively punishing rationality and rewarding insanity. This creates a feedback loop of reinforcement. The more reckless you were, the richer you got, which convinced you that your recklessness was actually brilliance. This arrogance was codified by the intellectuals. Irving Fisher, the most famous economist in America, a man of immense intellect and data, looked at the soaring charts and saw not a bubble, but a permanent plateau. He argued that the old cycles of boom and bust had been conquered by the Federal Reserve and the efficiency of modern industry. He provided the scientific proof that the mania was rational. Fisher was the high priest of the new era. When the smartest man in the room tells you that the party will never end, who are you to disagree? So, the American public leveraged their lives to buy the dream. They bought not just RCA, but Montgomery Ward, General Motors, and Union Carbide. They bought on the assumption that the ticker tape was a one-way street to paradise. They did not see the rot beneath the floorboards. They did not see that while stock prices had tripled, industrial production had only increased modestly. They did not see that the agricultural sector, still the backbone of the American economy, had been in a depression for a decade. They did not see that the wealth was dangerously concentrated, with the top 0.1% holding as much wealth as the bottom 42%. They saw only the numbers on the board, and the numbers said more. By the summer of 1929, the stock market had detached itself from reality entirely. It was no longer a reflection of the economy. It was a derivative of the economy, a phantom limb itching with a sensation that wasn't there. The smart money was starting to get nervous. The insiders were quietly distributing their shares to the public. But the public, blinded by the halo of technology and the recency of their gains, kept buying. They were building a skyscraper of cards, reaching higher and higher into the thin air, convinced that gravity had been repealed. They were about to learn with devastating clarity that gravity is the only law that never changes. To understand why the collapse was not just a correction, but a catastrophe, we must look at the mechanics of the market itself. We must look at the toxic plumbing that connected the average American to the floor of the New York Stock Exchange. That plumbing was called buying on margin. In the 1920s, you did not need to be rich to buy a share of stock. You only needed to appear rich. The brokerage houses had invented a system that allowed a man with $10 in his pocket to purchase $100 worth of stock. It was the democratization of leverage. It was the financial equivalent of giving a machine gun to a toddler. Here is how the trap worked. A shoemaker walks into a brokerage office in Kansas City. He has $1,000 in life savings, real, hard-earned cash. He wants to buy shares of Radio Corporation of America, RCA. If he bought the shares outright, he could afford 10 shares. But the broker, smiling behind a mahogany desk, offers him a better deal. Why buy 10, the broker asks, when you can control 100? The shoemaker puts down his $1,000 as a deposit. The broker lends him the other $9,000. The shoemaker now owns $10,000 worth of stock. If the stock goes up just 10%, the shoemaker doubles his money. He makes a 100% return on his cash. It seems like magic. It is alchemy. It turns the slow grind of labor into the lightning strike of wealth. But there is a catch. The loan is a call loan. The broker has the right to demand repayment of that $9,000 at any time, for any reason, immediately. And the collateral for the loan is the stock itself. This creates a terrifying mathematical asymmetry. If the stock drops by just 10%, the shoemaker's equity is wiped out. He has lost everything. If it drops 11%, he owes the broker money he does not have. The moment the price dips, the broker issues a margin call. The shoemaker must deposit more cash instantly, within hours, or the broker will sell the stock into the market to recover the loan. By 1929, this was not an isolated practice. It was the lifeblood of the entire American economy. There were over 300 million shares being carried on margin. The volume of brokers' loans, money lent specifically to buy stocks, had exploded from $1 billion in the early 1920s to over $8.5 billion by October 1929. That figure was roughly equal to the total amount of currency in circulation in the entire United States. The market was not floating on cash. It was floating on a mountain of debt that was disguised as wealth. The lenders were not just banks. This is where the contagion began. Corporations like Standard Oil and General Motors, sitting on massive piles of cash from the economic boom, realized they could make more money lending to speculators than they could by building factories. They started dumping their corporate treasuries into the call loan market. The interest rates were irresistible, sometimes hitting 15% or 20% for a single day's loan. It was easy money. So you had a situation where the car manufacturer was lending money to the car buyer, so the buyer could speculate on the manufacturer's stock. It was a snake eating its own tail. The entire system was circular, self-referential, and incredibly fragile. This brings us to the psychological bias of the illusion of control. When an investor buys on margin, they feel powerful. They control a large asset base. They see the upside clearly, but they are blind to the fact that they have surrendered control of their financial destiny to the volatility of the market. They believe they are the pilot of the plane, but they are actually strapped to the wing. The average American did not understand the fine print. They did not understand that a call loan meant the bank could pull the rug out from under them at the exact moment they were most vulnerable. They viewed the loan as a tool, not a weapon. And the banks encouraged this. They advertised, easy terms. They normalized debt. For the first time in American history, debt was not a mark of shame. It was a mark of sophistication. To be leveraged was to be smart. To pay cash was to be a sucker. By the summer of 1929, the leverage ratio in the market was approximately 10 to 1. For every dollar of real money, there were $10 of phantom money. This meant that a mere 10% decline in the market would theoretically wipe out the entire equity of the investing public. The structure was a house of cards built on a foundation of dynamite. The cards were the stock prices, soaring ever higher. The dynamite was the margin debt. All it would take was a single spark, a single day of selling, to trigger a chain reaction of margin calls. If the market dropped, brokers would call the loans. Investors, having no cash, would be forced to sell their stocks to pay the loans. This selling would drive prices down further, which would trigger more margin calls, which would force more selling. It was a feedback loop of destruction, waiting to be activated. The smart money, the astute observers like Paul Warburg and Roger Babson, saw this leverage and recoiled in horror. They saw that the market had become a loaded gun pointed at the head of the American economy. But the crowd, intoxicated by the easy profits of the last 5 years, kept pulling the trigger, believing the chamber was empty. They were buying the dream on margin, unaware that the bill was coming due, and the price would be everything they owned. By September 3, 1929, the Dow Jones Industrial Average reached its zenith, 381.17. It was the summit of Mount Everest. The air was thin, the view was spectacular, and the footing was treacherous. But to the average American investor, it felt like the ground floor of a new skyscraper. In this rarefied atmosphere where skepticism was treated as heresy, a single voice dared to speak the unspeakable. His name was Roger Babson. He was not a beloved figure on Wall Street. He was a statistician, a crank, a man known for his eccentric theories linking Isaac Newton's laws of physics to finance. Action and reaction are equal and opposite, he would say. If the market goes up too far, it must come down. On September 5, 1929, at the National Business Conference in Massachusetts, Babson walked to the podium and dropped a bomb. He did not mince words. He did not hedge. Sooner or later, he declared, a crash is coming, and it may be terrific. He predicted factories would shut down, men would be thrown out of work, and the vicious cycle of deflation would begin. The reaction was immediate. The market shuddered. This moment, known as the Babson break, saw stock prices dip sharply. For a few hours, fear flickered in the eyes of the bulls. The illusion wavered. The collective hallucination was challenged by a cold splash of reality. But the psychological immune system of the mania kicked in almost instantly. The establishment did not just disagree with Babson. They sought to destroy him. To accept Babson's warning would require the public to admit that their newfound wealth was a mirage. It would require them to sell, to pay their debts, to return to the slow lane of saving. The human mind, when faced with a truth that threatens its happiness, will aggressively reject that truth in favor of a comfortable lie. This is confirmation bias weaponized. The public did not want the truth. They wanted permission to keep dreaming. And they got it from Irving Fisher. Fisher was the anti-Babson. He was a Yale economist, a celebrity intellectual, the man whose index numbers were published weekly in the newspapers. He was the voice of authority. In response to Babson's grim prophecy, Fisher delivered one of the most infamous lines in financial history. Stock prices, he proclaimed, have reached what looks like a permanently high plateau. He argued that the market was not inflated. It was simply reflecting the new efficiency of American industry. He told the public exactly what they wanted to hear. You are not gambling. You are investing in a new reality. The market listened to Fisher. The dip was bought. The Babson break was dismissed as the ramblings of a pessimist. The market rallied, recovering almost all its losses. This recovery was fatal. It convinced the public that the market was invincible. It proved that every dip was a buying opportunity. It reinforced the belief that the bears were not just wrong but foolish. But while Fisher was speaking, the smart money was silently moving. The insiders, the operators who saw the balance sheets, the bankers who knew the leverage ratios, They were not listening to the speeches. They were watching the order flow. They saw the volume drying up. They saw the inventory piling up in warehouses. Joseph Kennedy, the father of the future president and a notorious market operator, later claimed he knew it was time to sell when a shoeshine boy gave him a stock tip. "When the shoeshine boy knows as much as I do," Kennedy reportedly said, "the market is over." Whether the story is apocryphal or not, the sentiment was real. The smart money was exiting the theater while telling the public to buy tickets for the next show. They were selling into the strength, unloading their positions onto the very people Irving Fisher was reassuring. By late September and early October, the market began to drift. It wasn't crashing, it was sagging. It was like a balloon slowly losing helium. There were sudden, inexplicable drops, air pockets, where prices would tumble for no reason, only to be propped up again at the close. These were the tremors before the earthquake. The volatility was increasing. The tape was running late more often. The unease was growing. But the psychological conditioning of the last 5 years was too strong. The public held on. They held on because they had been told that the plateau was permanent. They held on because to sell was to admit defeat. They held on because they believed that if trouble came, the bankers, the gods of the financial universe, would step in and save them. They were waiting for a savior. They were about to get an executioner. On Wednesday, October 23rd, the selling began in earnest. It was a cold, gray rain that turned into a thunderstorm. The Dow dropped significantly. The margin calls went out. The telegraph lines began to heat up. But even then, as the storm clouds gathered over Wall Street, the prevailing emotion was not panic. It was confusion. Why is this happening? Doesn't Fisher say we are on a plateau? They did not know that the plateau was actually a cliff edge. And they were already stepping off into the void. The next morning, October 24th, Black Thursday, would bring the first true glimpse of the abyss. The floor of the exchange was about to become a slaughterhouse, and the voices of the Cassandras, so long ignored, would be drowned out by the roar of a collapsing world. The sun rose on Thursday, October 24th, 1929, over a city that was already trembling. By the time the opening bell rang at 10 a.m., the fear had calcified into something harder: panic. There was no news. No archduke had been assassinated. No war had been declared. But the sell orders were piling up like snowdrifts against the doors of the exchange. The market opened, and immediately the floor gave way. Prices did not just fall, they disintegrated. Kennecott Copper, General Motors, Sinclair Oil. The names that had been the bedrock of American portfolios were suddenly trading at discounts of 10, 20 points. By 11 a.m., the ticker was already lagging behind the market, creating that deadly fog of war we spoke of. But this time, the fog was absolute. Rumors swept the floor that the Chicago Exchange had closed, that the Buffalo Exchange had closed, that suicides were rampant. In the gallery above the trading floor, where tourists usually watched the spectacle of capitalism, a hush fell. Among the spectators was Winston Churchill, visiting from England. He looked down at the chaotic pit below and later remarked that he saw a wild and frantic crowd behaving like animals in a cage. By noon, the market was in freefall. The loss of paper wealth was staggering, billions of dollars evaporating in hours. The terror was total. But then the machinery of the establishment began to turn. Across the street, at 23 Wall Street, the fortress known simply as the Corner, a meeting was taking place. This was the headquarters of J.P. Morgan & Company. Inside, the most powerful men in American finance gathered in the library. Thomas Lamont of Morgan, Charles Mitchell of National City Bank, Albert Wiggin of Chase National Bank. These were the titans, the masters of the universe. They did not panic. They calculated. They understood that the crash was not about economics. It was about psychology. The market was suffering from a crisis of confidence. To fix it, they didn't need to fix the economy. They needed to perform a piece of theater. They pooled their resources, roughly $250 million, over $4 billion today, to build a war chest. Their plan was simple. They would buy the market. They would act as the buyer of last resort. At 1:30 p.m., the doors of the New York Stock Exchange swung open, and the theater began. Enter Richard Whitney. Whitney was the vice president of the exchange and the floor broker for J.P. Morgan. He was a patrician figure, tall, arrogant, immaculate. He walked onto the chaotic floor with the air of a man strolling through a country club. The shouting died down. The traders parted like the Red Sea. They knew who he represented. They knew he carried the checkbook of the gods. Whitney walked straight to the post where U.S. Steel was traded. The stock was crashing, trading around $190. He looked the specialist in the eye and, in a voice loud enough for the entire floor to hear, he said, "I bid $205 for 10,000 shares. The silence that followed was deafening. He was offering to buy the stock at above the market price. He was defying gravity. He then moved to the next post and the next, placing massive buy orders for blue-chip stocks. He was not just buying shares, he was buying faith. This is the quintessential example of authority bias. The human brain is hardwired to defer to hierarchy. When we are lost, terrified, and confused, we look for a leader. We look for a parent figure to tell us that everything is going to be all right. Whitney was that figure. His action sent a signal that the smart money believed the market was undervalued. It told the small investor, if J.P. Morgan is buying, you should be buying too. And it worked. The panic broke. The selling stopped. A roar of relief went up from the floor. Prices rallied. U.S. Steel recovered. The market clawed back almost all of its morning losses. By the closing bell, the index was down only a few points. The newspapers the next morning screamed victory. Wall Street crash averted, they declared. Bankers halt decline. The narrative was set. The system works. The titans have stepped in. The floor is solid. But this was a lie. It was a trap. The bankers' rescue was not an act of charity. It was a strategic retreat. They had propped up the market just long enough to stabilize the price so that they could sell their own holdings in an orderly fashion. They were not saving the public. They were building a bridge so they could walk off the sinking ship without getting wet. The tragedy of Black Thursday is not that the market crashed. It is that the crash was arrested. The recovery convinced the average American, the shoeshine boy, the teacher, the widow, that the worst was over. It validated their authority bias. They looked at Whitney and saw a savior. So, instead of selling on Friday, they held. Instead of cutting their losses, they stayed in the game. They went into the weekend breathing a sigh of relief, unaware that the structural rot of the margin debt had not been fixed. The leverage was still there. The loans were still due. Richard Whitney's theatrical performance had bought the market 2 days of peace, but it had sealed the fate of millions. By convincing them that the big boys were in control, he ensured that when the real crash came, when the dam finally broke, the public would be fully invested, standing on the shore, watching the tidal wave approach with their hands in their pockets, confident that the wall would hold. It wouldn't. Friday passed with a deceptive calm. The market held steady, trading in a narrow range. The volume was heavy, but the panic seemed to have abated. The bankers' theatrics had worked, or so it seemed to the casual observer. But beneath the surface, the structural integrity of the market was dissolving. The tragedy of 1929 was not written on the trading floor. It was written in the telegraph offices during the long, agonizing weekend of October 26th and 27th. Normally, the weekend is a respite, a time to step away from the ticker, to play golf, to attend church. But this weekend was different. It was an incubation chamber for terror. While the stock exchange was closed, the brokerage houses were working 24-hour shifts. The clerks, their eyes rimmed with red, were not sleeping. They were calculating. They were going through the accounts of the shoemakers, the teachers, and the farmers, and they were applying the brutal mathematics of the margin call. Remember the leverage? The 10% down payment? The dip on Thursday, even though it had recovered, had triggered a technicality in thousands of loan contracts. The value of the collateral had momentarily dropped below the safety threshold. The banks, terrified by the volatility, were no longer interested in holding the line. They wanted their money back. So the telegrams went out. Imagine the scene. A Sunday afternoon in a quiet suburb of Chicago. A family is sitting down to a roast dinner. The atmosphere is tense but hopeful. Dad says the bankers fixed it. Dad says Mr. Whitney bought steel. And then a knock at the door. It is a Western Union messenger. He hands over a yellow slip of paper. The message is short, devoid of emotion, and catastrophic. Account underwater. Deposit $2,000 by Monday 10 a.m. or we sell at market. The father reads it. He doesn't have $2,000. He doesn't have $200. His money is in the market. To get the cash, he would have to sell the stock. But the broker is saying, if he doesn't send cash, they will sell the stock. It is a paradox of insolvency. This scene played out 10,000 times across America that Sunday. The telegraph lines, usually quiet on the Sabbath, were humming with the frequency of a hive. Western Union reported the highest volume of traffic in its history. This brings us to the psychological contagion known as the availability cascade. In 1929, there was no Twitter. There was no CNN. News traveled through social networks, church groups, country clubs, neighborhood bars. As the margin calls landed, the recipients didn't keep it to themselves. They called their brothers. They spoke to their neighbors over the fence. Did you get a wire? Yes, they want more cash. I don't have it. Neither do I. What are you going to do? I have to sell first thing Monday. This conversation, repeated endlessly, created a self-reinforcing feedback loop. The belief that everyone is selling transformed from a fear into a certainty. It wasn't just a rumor anymore. It was a coordinated, collective decision made by thousands of isolated individuals, all arriving at the same desperate conclusion simultaneously. The banker's rescue of Thursday suddenly looked very different. On Thursday, it looked like strength. By Sunday night, it looked like a trap. The public realized that while Whitney was buying stock, the banks were calling in loans. The smart money wasn't saving the market. They were just ensuring there was enough liquidity for them to get out. The psychology shifted from greed, I want to get rich, to fear, I want to survive. We see the recency bias in a generation of investors who have never seen a high-interest rate environment. We see the confirmation bias in online echo chambers where bears are mocked and bulls are deified. The technology has changed. The ticker tape is now a digital screen. The telegraph is now a fiber optic cable. But the software running the machine, the human brain, has not been updated in 50,000 years. We are still the same emotional, irrational animals we were in 1929. We are still driven by the fear of missing out and the terror of being left behind. History does not repeat itself, but it rhymes. And if you listen closely to the markets of today, you can hear the faint, rhythmic chattering of a ticker tape from 1929, whispering a warning across the century. It whispers that the party always ends. It whispers that trees do not grow to the sky. And it whispers that the moment you believe this time is different is the moment you have already lost. There is a statistic that haunts the history of the 1929 crash, a number often buried in the footnotes because it is too depressing to contemplate. 25 years. That is how long it took for the Dow Jones Industrial Average to return to the peak it reached on September 3, 1929. Think about that timeline. A man who was 30 years old when he bought RCA at the top was 55 before he broke even. He spent his entire prime working life, his years of raising children, building a career, fighting a world war, underwater. He watched the market rally in the 1940s. He watched the post-war boom of the 1950s. But he did not participate. He couldn't. His psychological capital had been destroyed long before his financial capital. He had learned a lesson that was seared into his amygdala. The stock market is a casino where the house always wins. On November 23, 1954, the Dow finally crossed 381 points again. The newspapers celebrated. But the generation of 1929, the lost generation of investors, mostly missed it. They were sitting in cash, in bonds, in real estate. They had missed the greatest wealth creation engine in history because they were paralyzed by the ghost of Black Tuesday. This brings us to our final and perhaps most tragic psychological bias, the forgetting curve. Human memory is finite. The pain of a burn fades. The terror of a crash dulls. Nature designed us this way. If we remembered every trauma with the intensity of the moment it happened, we would never leave our caves. We would never take risks. We would never innovate. But in finance, this biological mercy is a curse. The forgetting curve ensures that financial wisdom is not hereditary. You cannot pass your fear of a bubble down to your children. They have to learn it for themselves. The generation of 1929 died out. Their children, the boomers, saw the crash only as a black and white photo in a history book. To them, it was ancient history, irrelevant to the modern world of computers and globalization. And so, they built their own bubbles. The Nifty 50 in the 70s. Black Monday in 1987. The dot-com mania of 1999. The housing bubble of 2008. Each time the new generation said the same 4 dangerous words. This time is different. In 1929, they said it was different because of the radio. In 1999, they said it was different because of the internet. In 2008, they said it was different because of mortgage-backed securities. Today, in 2024, we say it is different because of artificial intelligence. The technology changes. The narrative changes. The acronyms change. But the human operating system does not. We are still driven by the same dopamine hits, the same herd impulses, and the same hubris that drove the shoeshine boys of 1929 to buy on margin. We look at the charts of 1929 and we laugh at their naivety. We think, how could they be so stupid? How could they not see the cliff? But we are looking at the chart backward. We know the ending. They lived it forward. To them, the cliff didn't look like a cliff. It looked like a stairway to heaven. The lesson of 1929 is not about economics. It is about humility. It teaches us that the market is not a calculator. It is a mirror. It reflects our collective greed, our collective fear, and our collective delusion. When we look into that mirror and see only infinite profits, that is the moment the glass is about to shatter. The crash of 1929 was not an anomaly. It was a feature of the system. It was the forest fire that clears the dead wood. It was cruel, it was violent, and it was inevitable. And as long as human beings are in charge of money, it will happen again. The ticker tape may be digital now, scrolling silently across our screens, but the message it taps out is the same one it tapped out on that cold October Tuesday. Price is what you pay, value is what you get, and panic is the only thing that is free. The history of money is the history of human psychology. If you want to understand where the economy is going next, don't look at the charts. Look at the people around you. If you found value in this analysis, if you want to arm yourself against the next cycle of mania and depression, subscribe. We are building a library of financial history here. We dissect the past so you can survive the future. Join us. Because the next Black Tuesday is already being written. We just don't know the date yet.